All right. Welcome to the Dynamic Investing Podcast with myself, Tim Travis, and Erik Gebhard. Erik and I have known each other about 22 years. And Erik, how long have you been in the industry?
Since the early 90s.
Crazy. So you got me beat by a decade.
Yeah, just about. That's right.
yeah. We've seen a lot together and apart, excuse me, there. But before we start, I just want to mention there's risk in all investing. Options aren't suitable for all investors, and past performance is not indicative of future results. So, Erik, once again, a pretty wild week in the markets. What are kind of your thoughts on what we've seen, going on lately?
Yeah, that's a good question. And I'm going to ask you a bunch of questions too.
Sure.
So we'll kind of go hit the ball back and forth across the net. But, I think the stock market is, all things considered, holding up quite well. I mean, looking at where we were in, was it January? The record high in the SPX, I think, was 69.80, somewhere around there. I think we're now just about 5%. Maybe today's intraday low would have been more like 5% off of that high. And I know the small caps have done, a bit worse, which is typical, more volatility in the Russell 2000, for example. That makes sense. But certainly that's a large shot across the bow when you have oil up above 100, and that flows through every asset class, and um, you can't really expect volatility, say on the VIX, for example, to be any lower than where it is. In fact, I'm a little bit surprised that it's not a bit higher. I think there's perhaps some options flows that are working in that space to perhaps mute the volatility just a little bit. But nonetheless, yeah, I think everyone's following the bouncing ball, which is, I think oil right now is sort of leading, and that's impacting treasuries. But it's tough to navigate and find your spots, but the spots are out there, and I think you're going to
Oh,
talk to us a bit about some of that in the
yeah.
next minute here or two, about where you're looking specifically for opportunity. But what are your thoughts on how all this can play out?
Sure. Well, under the hood, there's a lot of carnage out there. I mean, you look at Microsoft, it's down 27%. Palantir's down 27% from their highs. Salesforce.com's down 35%. I think Adobe's down 45% at least. So there's a lot of damage that's occurred in a lot of these big name stocks. And it's interesting that the indices haven't fallen more. I would agree with your sentiment. I think that it's rare historically where you see this type of divergence between a lot of these larger stocks and the indices. Normally, when such a large percentage of stocks are down so much from the highs, you see the indices down more. Who knows? Maybe it's just fund of funds, kind of like all this money flows into these index funds and it just keeps driving them higher until that stops, until people stop making those contributions directly into the S&P, because it's kind of, it just rises all boats a little bit. So I think it's a different dynamic than it was 30 years ago because so much money flows into them. But I also think that the opposite could occur when money starts flowing out. But it's been interesting. Once again, we've seen a lot of hysteria about private credit. I know that we were going to talk about that, and so I'll just kind of jump into it. It
Sure,
it it
absolutely. I mean,
it
how have things changed in the last week, for example, if at all? I
uh,
think there was a comment from John Gray, isn't he CEO of Blackstone, I believe?
right.
And I think he had some, of course, what do you expect a CEO to say in public during an interview? They're going to be positive, but sometimes it seems more credible than not, and you can kind of, you know, sniff out, some of the baloney sometimes. But he
Right.
seemed very adamant about their position and the the space itself. But maybe you have some thoughts on that yourself. what's
No.
what's going on, but not necessarily only with Blackstone, but just in
Right.
that space.
Right. I would agree. Well, so there's kind of a misconception. So there are certain funds. Some of them are business development company funds, but they're privately traded. Okay. So when advisors sell these funds to clients, they're selling it on the premise that, look, you're not going to have mark to market trading on these things. These aren't, you're not going to see a price every single day. You're going to see the net asset value every quarter. You're going to get your dividends. There's less liquidity than there are in publicly traded stocks, but you're also not going to see as much volatility in the investment. Now, I want to put a disclosure here. I've never sold a privately traded BDC or a privately traded REIT because I don't like that liquidity aspect. But some people do. And truthfully, there is some merit into it because a lot of mistakes that investors make is when they're just overly concentrated on short-term performance. They look at it every day and they think that, oh my gosh, I'm down 5% in 2 weeks. What's going on? Is this stuff ever going to recover? And it's like that is inevitable. You're going to get noise in your portfolio. And you need to focus on the long term, focus on meeting your retirement goals. So there is some merit in there. But what the hysteria is that right now there's been so much really news and hysteria related to private credit and there was like two defaults which were actually bank loans. They weren't even like private credit loans, but they were bank loans that defaulted last year that kind of started this. And so then you have the AI potentially endangering some of the software companies and that's another narrative that's been out there. So some of these loans have gone down in value a little bit, and the market is some of the market participants are saying, well, if everything's marked to market, they're going to be showing more losses on their portfolios. And so, the reality is though is that these portfolios are meant to be liquidated over time. These aren't loans that trade like on the stock market. So you can't just sell everything all at once, and you wouldn't want to do that. That's not going to give a good outcome for investors. But what happens is that every quarter, every year, a large percentage of these loans are being paid off. So they're returning cash to the funds. That cash can go to shareholders. So that's why normally they have like 5 or 7% a quarter redemption policies, or sometimes it's monthly redemption policies. But it would be against everyone's best interest if you had 30%. You just liquidate everything at fire sale prices, and then everyone knows you have to sell, right? So it's a cascading impact. And one of the things I've noticed is that a lot of the people really, bad mouthing the industry and talking and projecting fear are people that run like bond funds that benefit from money leaving private equity and going into their funds, like Jeffrey Gundlach, for instance. And they're comparing it to things that are totally different, like CDOs in 2008. So, look, I don't really have a dog in the fight. I'm not a private equity investor particularly. I do think that right now there's value in the private debt. And the other big disconnect, Erik, is that okay, these are first lien loans that people are worried about. And of course, there's going to be some defaults, but the average position size in a lot of these funds is 0.4%. So if you have a few defaults,
Mm.
it's very manageable. And these aren't all highly correlated to one another. But if, like we talked about with the S&P 500, if people are worried about the first lien debt, why are equity valuations so high? Why is the index where it is? Because the whole equity sliver would have to be wiped out for these loans to be impaired. So I think that disconnect just doesn't make sense.
No, that was excellent. So I think, maybe you can almost equate some of this to a typical hedge fund that has gates and kind of incremental withdrawals and that type of thing, because it's really protecting the investor and all the investors from, large sudden withdrawals and kind of creating a rush for the exits and liquidity issue. You don't want to just throw throw everything you have up for sale all at once when you're moving big positions around like that. So,
Right.
and we're not talking about a typical retail investor that owns, these types of investments either. These are sophisticated people. They've done their due diligence, so they know what the terms are. And yeah, that's a lot of granularity, and that's good detail and good context for people to understand about what's going on in private credit and kind of what's, under the hood, so to speak. So yeah,
Yeah.
that's very good.
I'd make
Um,
one more comment just to
yeah.
elaborate on that. So you probably would remember, a lot of people wouldn't, but we're old enough where we can remember is what ultimately stopped the financial crisis. And people forget this, but that was just a cascading event where everyone was obsessed with the mark to market marks on like the bank loans, the CDOs and all that stuff. And so it's like, oh, if you mark everything to market, you got to report these huge losses, and then the banks have to keep raising capital.
Hmm.
And it's like this cycle, and everyone knows they have to raise capital. So these loans go lower and lower in value, but none of it was based on like the actual underlying quality of the loans. I mean, of course, when they were originally underwritten, they weren't underwritten well. There was a lot of fraud, but at some point, prices just became totally disconnected from the reality of what the assets were. And so then what happened was in, I believe it was March of 2009. Actually, I'm
That's
positive it
right.
was. They basically said that the regulator said, okay, we're going to stop mark to market accounting, and they put in some barriers on that. And when that occurred, that marked the very bottom of the stock market, because what happened was that negative feed loop ended. And then it's like when you actually look at the cash flows of those bonds, even like the bad CDOs that had already been marked down a lot, they performed fabulously well moving forward. It was just that negative feedback loop. So what I'm saying is, if you have people like Jeffrey Gundlach, who I like Double Line, I like he's a good bond manager, he's an interesting guy, but these are people that benefit from an exodus in private equity. And if they're screaming doom doom, well, if everyone, why can't everyone get all their money right now, when that's the obviously there's reasons for that. The rules are against that because you're going to harm everybody. They're trying to create chaos in that sense, and many of these people have short interest in it. So I would just say there's a big difference between the reality. If you look at like the actual credit quality, the amount of defaults and stuff like that, that is totally disconnected from the narrative in the stock market. So for the prudent long-term investor that can take a little bit of volatility, there's huge opportunities buying some of these things at 65 cents on the dollar, 60 cents on the dollar. But that's just an analogy for folks out there that might not remember that time. The mark to market hysteria is kind of a classic a classic warning to you, because it'll always cause a cascading event when it's just the only focus.
Yeah, no, very good point. March 2009 for sure. I remember that vividly.
Yep.
I remember the SPX, was it 666 was the
Yeah.
bottom.
Ominous. Very ominous. Right.
Anyway, also one other comment, and then maybe you want to drill down into specific tickers in this space if you want to mention a few. You mentioned some of
Sure.
these things, uh, basically pulling back and giving us a chance to buy into these things on a let's say a dip, to say the least, right? Some of these
Yeah.
are on a large dip, to say the least. But one other thought I had too was, we had just mentioned how, yes, the stock market, the S&P 500, for example, is off of its highs, maybe 5% or so since January. So that certainly leaves a mark. That moves the needle a bit, but not even nowhere near a crash or correction or anything, especially with what's going on in the uh, geopolitical landscape. But I also thought that even with the Mag 7 being down, you mentioned some of those other tickers, and I think the only one of the Mag 7 that's even, well, I'm trying to remember which one it is. Is it oh, I can't remember which one, even kind of close to being even year to date. But
Might be
anyway,
Tesla or Google. I forget which ones.
it might be
Google
Google.
had a big run
It,
last year. But
yeah,
yeah,
I
I
think
forget which
Google
one
might
too.
might be, but nonetheless, as we saw up until just last year, it was the Mag 7 with this high concentration in the stock market in general, 35% of the market cap. And now you've seen them sell off quite a bit, and the S&P seems to be kind of a bit resilient. So you kind of have I think, some broader base strength in the S&P here of late, which is interesting. And even in spite of what's going on. So I don't know what to make of that one way or another, if you had any thoughts on that.
Well, you look at valuations, it's like Walmart at 45 times earnings, Costco at 55 times earnings. So there's some really bizarre valuations where you have Amazon at 23 times earnings. So there's a lot of kind of there's a lot of bubbles out there. I was surprised. Okay, if you have a lot of these asset managers and BDCs, which are debt companies, if they're trading at huge discounts to book value, why do we have JP Morgan trading at 3 times book value? I mean, their CFO or CEO, I forget who was saying it. I think it was their CFO, was talking the other day in a conference and was saying that it doesn't make economic sense for them to buy back their stock because their valuation's so high. I mean, that's just the reality. And I appreciate him
Hmm.
being honest about that, because so many management teams, they just buy back stock irrespective of the intrinsic value, and it doesn't make sense. It's value destructive. So I appreciate that they're paying attention to that. But even we've been huge advocates of the banks, me personally, and our company, for the last, ever since the financial crisis. We've been investing in these things. Right now we really have very little exposure because the valuations are quite pricey. And when you get economic dislocations, you get this war is hugely problematic because oil prices, energy prices are rocketing, and then that puts pressure on inflation. So inflation is picking up again, and that hurts the Fed's ability to cut interest rates. That hurts the housing market. That hurts affordability. I mean, things are already so expensive. There's you have the K-shaped economy right now, and most people are struggling unless you have a lot of assets in the equity markets or something like that. So it's very dangerous, and I think that there's a lot of overvaluation in there.
Hmm. Yeah, excellent. In fact, looking at the bigger picture, you kind of hinted at it there and touched upon it. Maybe you had some thoughts. Today we had Q4 GDP. I think it was it revised? Well, I think revised from 1.4% down to 0.7% annualized.
Right.
I think because of government spending
Yeah.
being
Of
reduced.
course. Yeah.
Q1 Atlanta Fed projections for this year are, I just wrote it down, 2.7%. You've got some consumer sentiment data out today, down from last time, but a little bit better than expectations. You have the PCE, I guess that's the core PCE, the
Right.
Federal Reserve's presumably favorite uh, parameter, I guess you could say,
Hmm.
but that's up over 3%, 12 months. So, they're certainly not at their 2% target, but the numbers from today don't reflect what's going on in
Oh,
in Iran.
no.
So I think there's going to be a large spike. And what is that going to do with our interest rate policy moving forward? Are we going to be forced to be tighter? And maybe President Trump doesn't get what he wants out of the new Fed chair, Warsh, anticipating, rate cuts. That would
Feels
just
like
seem
that.
to that would
It
just
feels
seem to
like that.
fan the flames of price inflation.
Right.
And but you get into that scenario now where you have there's a phrase, fiscal dominance. So I don't know if you want to speak to that at all, but you know this is big picture stuff. But
Yeah.
with all that in mind, how do you, I guess what I'm getting at is, with all that in mind, that tends to become the landscape or the background for everyone as an investor. You can't really avoid that or sidestep it. I mean, that's just kind of the playing field that you have. But how do you pick your spots? Are
Yeah.
you looking at, you have criteria that you use and that you look for to kind of bypass all the noise to really search for value.
Right.
So, maybe you have some thoughts on that. I don't know if,
Yeah.
yeah,
The key is there's always so much noise. And I think that if you're focused on those headlines and the macroeconomic elements of it, it's really hard to make money. You know who John Hussman is. He's a
right,
really smart guy, PhD, but he's been bearish for the last 25 years, give
right,
or take. And his performance has been awful because of that. But I mean, he could probably kill me in an IQ test. But the reality is that he gets so lost in the weeds with the doom and gloom and the fear of things, and the data analysis, the statistical analysis, that he forgets the microeconomic picture. So what we want to do is we want to focus on individual companies. And yes, they're impacted by the war and by inflation, but we can assess the impact more in depth on a microeconomic level. And so what we want to do is we want to find companies that are trading at large discounts to intrinsic value, many companies that actually benefit from these dislocations. For instance, we've been big investors in master limited partnerships energy infrastructure. These are very attractive opportunities. A lot of these things going into the year had dividends of 7.5 to 9%,
Wow.
and they're trading at low valuations, and they're kind of like utilities in that they allocate large sums to capital expenditures. Some of that is for growth, some of it's for maintenance, but those capital expenditures get kind of like a almost a very high probability return. And so they get a decent return. They're not hugely explosive investments, but they benefit from the dominance that North America has in terms of energy, in terms of our own energy needs and production. Obviously, with the shale drilling and all that, it's been very beneficial for them. And so now, our exports of LNGs and exports of oil are also very important because of the Strait of Hormuz being blocked, and then also there's the sanctions on Russia and everything. So it's more and more important. So those stocks have done really, really well. I think you also want to focus on like hard assets. If you look at things like some of these real estate names, uh, these aren't going to be necessarily displaced by AI. I mean, people are going to still need places to live, apartments, whatever. And so I think some of those hard assets trading at really discounted valuations that pay you a really good dividend while you're waiting are hugely attractive opportunities. So we're putting a big focus on cash flow, dividends. We want to get kind of a return of our money and a return on our money, and that will allow us to kind of dollar cost average into things, buy more securities, as they get cheaper. The other thing is the spike in volatility. We're seeing much better option pricing, so we've been able to sell puts at much higher
Hmm,
premiums.
good point.
Yeah, and that's huge because not only are you able to, target higher returns on your selling of options, but you're also able to build a bigger margin of safety. So whereas to maybe generate a double-digit return 4 weeks ago, you'd need to be, let's just say, hypothetically, 10% below a stock. Now we might be able to get that same double digit return at 25% below the current stock price. So we're able to build a bigger cushion into our investments and into our portfolio. But the whole key is weathering the storm. Keep that long-term approach, focus on the fundamentals, don't panic, don't buy into the hysteria. That's literally the one way you can be assured of losing is just by panic selling. That's the worst thing you could do.
Right, right. Well, as humans, we have the emotions that
Yes.
tend to get in our own way. But so you're selling puts, cash secured puts that are sometimes 25%
Yep.
below where you're long the stock
Well, yeah, I mean, where we
with the
could buy the stock
volatility
today,
higher.
where
Right,
where we could buy the stock today, and exactly, and so it builds a big margin of safety.
right.
And now that's an interesting part though. So like, I'm just gonna like I'm gonna use like a hypothetical example. Like let's say there's a $10 stock right now, and let's say that we sell a put at $8. Okay, we're selling an $8 put that expires in January, and let's say we collect 15%. All right. So what the only thing that matters is where does this stock trade at expiration in
Right.
January? If it's above 8, we make our 15%. If it's a below 8, we're going to end up owning the stock at $8 minus that 15% premium. Well, okay. Well, if the stock's down a lot tomorrow, then what was a 15% premium might be a 20% premium, and you're down 5% on your put, right? So okay, if we mark to market and if you're down 5% in a day, that seems really bad. But what is our plan? What is our focus? This is an undervalued opportunity. It's already an undervalued stock. We'd be happy to own it.
Right.
And the only thing we care about is once we get to expiration, volatility is going to go to zero, time value is going to go to zero. So is that stock above $8? If so, we just made 15%. If it's below, then we own the stock at 8 minus 15%, and we have all the upside or downside from there, the dividends. So that's why it's important not to get too focused on the short-term noise. It's a wonderful strategy. I mean, look, it's volatility is what option selling is built for. I know you know that very well. That's
Right.
I mean, it is a fun time when you see this type of spike.
No, that's great. So basically, you're using those cash secured puts as part of a incremental accumulation plan in
Yeah,
so many words. Yeah, absolutely.
yeah.
Okay. Well, let's see. How about, is there is there anything you can tell us about your portfolio and how you manage it, without getting too deep into the weeds, but, are you looking at having let's say, a diversified portfolio of, five tickers in this sector and five in that sector and another five in this other sector, for a total of, 25, 30, or 40 or whatever it might be? Or are you just purely driven by, you know, what the uh, what the machine tells you to do in terms of your own machine?
Yeah, yeah.
You're uh, you're running scenarios and whatever meets the criteria, and that's what you get. And it doesn't necessarily matter if you don't have anything or much exposure to industrials, if you have a lot of exposure into retail or whatever it might be. So are you thinking about it holistically like that, or
No,
not
it's a
so
great
much?
question. We're not focused on like mimicking the index, that's for sure.
Okay.
But we do want some level of diversification. It's important. Like when energy was super cheap, of course we wanted to own energy stocks because they offered good, attractive value, but also it's a nice hedge against inflation, which is a big risk right now. And I think we knew that there was the possibility we could see, a war in Iran. I think you have to watch out for China. I mean, is China going to feel like they have a license to go into Taiwan with our moves in Venezuela and now Iran? That's possible. I think you want reasonable diversification on certain when whole asset classes or sectors get cheap. I think it's good to spread the risk out a little bit. So like if real estate investment trusts are really cheap, having a basket of those, the BDCs having a basket of those. I
Hmm.
think there's opportunity in some of these asset managers that have been hit. So like the Blackstones, the Ares Capitals, the KKRs, the Blue Owls. These
Right.
stocks have gone down 40%. And I think there's a misunderstanding. A huge percentage of their capital is permanent capital. It's not necessarily subject to redemptions. It's long-term permanent capital that they're earning fees on. They're raising fees aggressively. I did a newsletter article where I talked about Owl. Owl grew its revenues by 20% last year. And the stock's
That's a
trading at
lot.
about, yeah, it's trading about 10 times its distributed earnings. It's got a dividend of like 10% now. I mean, these are very strangely good numbers for an asset management company that's not taking, credit risk themselves. That's in their portfolios, the business development companies, but that's spread out in within the funds. The funds are taking
Right.
that risk. So yeah, I think that that's interesting. Healthcare was cheap last year. When United Health and Cigna and CVS, they got hit pretty hard, and that whole asset class went down. We did buy kind of a basket of some of those things. We did really well on Centene. We sold some puts on United Health, which worked out pretty well. But there's still a lot of dislocation in that space. So I think that there will be more opportunities in healthcare. Another one like Berkshire Hathaway, right? Like
Mm.
that stock, Buffett retired, and the stock started to sell off quite a bit. They're sitting on I think it's like $350 billion of cash. So they have huge optionality to make money in a dislocation. And then it was odd. It was I started buying the stock, and I think it was the very next day that the CEO said, "Okay, we're starting our stock buyback again."
Uh-huh.
So they see value. He talked to Buffett too, and he said, I mean, I think our stock's undervalued. Do you agree? And Buffett said yes, and so he started buying that. So there are opportunities, but we just need to be very disciplined in what we buy and how we approach it, but also battling the psychological demons, right? I mean, that's the biggest thing. When you get market panics, when you get volatility, it's easy to get scared. It's easy to look at your portfolio every day. You think, oh, I'm down $10,000 from where I was 2 days ago. How do I get that back? That's so much money that takes me however much time to make. It's not that. We're not, you're focused on the long term. You're not realizing losses in most cases. It's just part of the noise. It's
Right.
turbulence when you're flying. You're going to encounter turbulence when you fly. You don't jump out of the plane when you encounter it. That's the key.
Right. Right. Well, you're going to have, intraday drawdowns, intra-week, intra-month, and, someone like Stanley Druckenmiller, people have commented, and he made a comment that people will sometimes say, well, he managed money successfully for 20 some years, almost 30 years without ever having a losing year. And I think I heard him say something or read something about it. He said, well, there were some big drawdowns along the way. They just they just didn't get they just recovered by the end of the year. But in any case, but no, that's a good point, Tim. And I think that's a big benefit of a professional money manager. And I've done it myself where you just get over involved with your own investing, and you start to you start to hear, voices in your head from all different angles, and you read too many things, and you watch too many things, and you hear too many things, and you're trying to process it all, and then you realize you're way off base, and had you just done nothing, you would have been far better off. And so I think sometimes we get in our own way, and that's
Do.
that roller coaster of emotion. When you're trading, you want to have your money professionally managed. If you're not able to do it yourself in a professional manner, that's for sure. That's a big benefit of this, is to keep you on track, keep you steady, and help you just bypass all that clickbait, all those headlines, and you can go about your life and enjoy your own day-to-day activities with your friends and family. You don't necessarily probably want to spend all your time, glued to your screen and watching the headlines in the middle of the night when, the futures are trading. So,
Yeah, it's a miserable lifestyle doing that
yeah.
for sure. So there's a lot of value there. But I'm optimistic. I mean, God willing, this war does not last that long. I I don't understand it myself. I don't want to get into the politics aspect. I don't understand it. I don't think it's the smartest move at all. And I think that it's going to be very difficult to control the Straits of Hormuz without compliance from Iran. It seems like it's pretty easy for them to cause havoc. And if there's a 10% chance that your tanker is going to get hit by a missile, or a 5% chance, no company's going to want to insure
Right.
that, right? And it's going to cause elevated prices. It's just a huge lose lose. We're going to spend $1 trillion if this thing lasts a year at least. So hopefully that winds down. I really don't think that. I think there's already a lot of pressure for it not to be a long campaign. And you could get what you got with the tariffs when he kind of took the tariffs back last year. You could get a huge relief rally. And then I also think earnings coming out, after, in April, once earnings start
Good
coming out,
point.
you start seeing, okay, what's the actual, what are the fundamentals of our businesses doing? Okay, it's not nearly as bad as people thought. Like these software names, for instance, like Adobe reported a really nice quarter yesterday. That stock's been hit hard, but the stock's selling off because the CEO is announcing, he's a very famous guy. He's done a great job over the last 30 years, and he's stepping down. And so the
Right.
stock's down a bit today. But I think when you look at, okay, is AI eating up these software companies, or is AI actually utilizing these software companies to as tools to do a better job? And I think that that's kind of the way it seems like it's going. But
Right. Right. Yeah. Just real quickly too, I had
yeah,
read that this week. I've read something about how, was it, maybe I can't remember the name of the large company, but essentially they had to bring back all the software engineers that they had recently fired. Uh, they were using AI, and then so they fired their software engineers, but then they had to bring them all back to correct all the problems that AI
that's
coding
happened
was
with a
giving
few
them.
of them. I
Yeah,
think
yeah.
Amazon just had a big issue with that.
That
That
was
might be the
Amazon.
one you're referencing.
Yeah,
Yeah, but that's been kind of like a recurring theme. And
yeah.
I think you're going to see more and more of that. But well, that kind of concludes the time we have for today, Eric. Thanks
Yes.
so much. As usual, we'll try to do these weekly, or at least bi-weekly, and hopefully add value, and hopefully be a source of comfort when people get a little scared in more tumultuous, volatile periods. It's nice just to have a little insight and a little more granularity into kind of the workings of the portfolio and the markets. So thanks so much, everybody, and we'll see you again next week.
All right. Talk to you soon. All right. Bye
Okay,
bye.
bye bye.